Hi, I am Anna. I come from www.ntvforex.com. Powell's Jackson Hole speech in Focus A8 is what the market chatter is all about. Analysis http ntvforex.com News ID 1F7A8E8262021 30:35 p.m. There is a lot of focus on Jay Powell's virtual Jackson Hole speech tomorrow, during which he is likely to tee up a new monetary policy framework based around average inflation targeting 8. We touched on this briefly this morning in terms of the market dynamics, but it's worth looking at what is meant by an average inflation target. We should note that this is set to be the culmination of a nearly 2-year process to review the strategies, tools, and communication practices it uses to pursue its congressionally assigned mandate of maximum employment and price stability. At its July meeting, the FOMC indicated it was near to finishing after COVID-related delays. Tomorrow we should hear Powell announce some key conclusions from the review. 8 is what the market chatter is all about. A yield curve control was largely dismissed at the last FOMC meeting, so I would not anticipate Powell to signal that the FOMC has suddenly come round to the idea. Why opt for 8? A BIS study, average inflation targeting and the interest rate lower bound, April 2, 2020 found that 8 improves welfare considerably after a major economic shock such as we have had. So long as everyone is rational, this is a problematic assumption in itself. Following a large recessionary shock that drives the policy rate to the lower bound, a central bank with an 8 objective engineers a temporary overshooting in future inflation that helps to mitigate the decline of output and inflation at the lower bound via the expectations channel. They note that the window for 8 should be finite but sufficiently long. A San Francisco Fed study, average inflation targeting and the effective lower bound, August 10, 2020 set out what should be the central pillar of the Fed's new approach to inflation. If the public perceives it to be credible, average inflation targeting can help solidify inflation expectations at the 2% inflation target by providing a better inflation anchor and thus maintain space for potential interest rate cuts. It importantly can help lessen the constraint from the effective lower bound in recessions by inducing policymakers to overshoot the inflation target and provide more accommodation in the future. Credibility is a question that the market will answer. As Powell put it in a speech in June 2019, to achieve buy-in by households and businesses, a comprehensible, credible, and actionable make-up strategy will need to be followed by years of central bank policy consistent with that strategy. I find this idea of 8 being a better anchor for inflation expectations problematic. Whilst I don't pretend to being an economist, regular readers will be familiar with my view that a sharp bounce back in growth, albeit to a level still below pre-pandemic potential, combined with unlimited Fed accommodation, a vast increase in the money supply if not yet the velocity of money, and a massive fiscal put is basically inflationary. Remember, as Friedman put it, inflation is always and everywhere a monetary phenomenon that arises from a more rapid expansion in the quantity of money than in total output. The rate of expansion in the monetary base is consistent with past bouts of high inflation in the 1930s, 1940s, and the 1970s. Whilst post-GFC QE led to money printing, it was gobbled up by a financial system hungry for capital and balance sheet repairing. The fiscal stimulus this time makes it a very different environment. Layer on top of that the disruption to supply chains and fundamental shift in deglobalization trends, and you create conditions suitable for inflation to take hold. If the Fed also indicates it does not care if inflation overshoots for a time, and indeed is actively encouraging it, there is a risk inflation expectations become unanchored as they did in the early 1970s, which led to a period of stagflation. Inflation expectations have bounced back sharply since the March low. The San Francisco Fed study notes emphasis in bold: my own, since the central bank achieves the 2% target rate on average, households and businesses can use this rate of inflation as a basis for long-term planning and their inflation expectations will be firmly anchored. Despite its conceptual simplicity, it may be challenging to determine how much inflation overshooting is required to achieve the targeted rate on average, and the degree of overshooting may need adjustments over time. However, frequent adaptations may make the policy less credible. In that case, the effect on inflation expectations might be dampened if households and businesses doubt the future course of policy. This policy framework may be less effective as a result. This credibility issue is at the heart of things. Does the market have belief in the Fed's ability to massage inflation? My concern would be that once you let the inflation genie out of the bottle, it can be hard to put back in without aggressively tightening and likely as not engineering a recession. Nonetheless, this seems to be the way the Fed is going. Paul Tudor Jones put it best back in May when he said that the question of whether the current bout of money printing will ultimately prove inflationary comes down to how reasonable is it to expect that in the recovery phase the Fed will be able to deliver an increase in interest rates of a magnitude sufficient to suck back the money it so easily printed during the downswing. Most agree it won't be easy. In fact, it would effectively kick the can down the road for many years. The Fed is not even thinking about sucking the money back in. This ought to stoke inflation, but it could be more than the Fed wants. The genie is coming out. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.